The U.S. Federal Reserve has left interest rates unchanged but signaled a more hawkish outlook, with several policymakers expecting rates to move higher before the end of the year. The prospect of tighter monetary policy rattled financial markets, sending stocks lower, Treasury yields higher, and boosting the U.S. dollar. Our Seung-jae has more.
The U.S. Federal Reserve on Wednesday left its benchmark interest rate unchanged at 3.5 to 3.75%, marking its fourth consecutive meeting without a rate move and its first policy decision under new Chair Kevin Warsh. The Federal Open Market Committee unanimously voted to keep rates steady as policymakers assessed the economic impact of the ongoing U.S. Israeli war against Iran and a recent surge in inflation.
As you saw a few moments ago, the committee decided to maintain the target range for the Fed funds rate at 3.5% to 3.75% in support of the Fed's dual mandate. Economic activity is expanding at a solid pace, despite elevated uncertainty that owes in part to the conflict in the Middle East.
While the Fed held rates steady for now, its latest projections signaled a more hawkish outlook. The median forecast indicates that the federal funds rate will end the year at 3.8%, higher than the 3.4% projected in March. In addition, 9 of the 19 Fed officials indicated they expect interest rates to be higher by the end of the year. Warsh did not submit a projection in the Fed's closely watched dot plot. Wall Street on Wednesday reacted negatively to the prospect of tighter monetary policy. U.S. stocks closed sharply lower, with the Dow Jones Industrial Average falling 0.97%. The S&P 500 dropped 1.21%, while the Nasdaq Composite lost 1.34%. Treasury yields moved higher as investors increased their bets on a rate hike later this year. The yield on the 2-year Treasury note jumped 17 basis points to 4.21%, while the benchmark 10-year yield rose to 4.499%. The stronger rate outlook also boosted the U.S. dollar. The dollar index, which tracks the greenback against 6 major currencies, climbed 0.9% to 100.45. The Fed's latest decision suggests policymakers remain cautious about inflation risks, while markets are increasingly preparing for the possibility of higher borrowing costs in the months ahead. Seung-jae, ArirangNews.